Those rising delinquencies we just talked about would seem to be a warning sign into the holiday shopping season this year. And sure enough, both of my next guests are expecting a weaker season. And that could be a headwind for stocks, but should also help to keep inflation down. Here to explain are Brian Reynolds, Chief Market Strategist at Reynolds Strategy, and Julie Beal, Portfolio Manager at Kayne Anderson Rudnick and a CNBC contributor. Welcome to both of you. It's great to have you both here. Julie, let me just start with you and what you're seeing, as you kind of look through the stocks and are trying to piece together your portfolio into year end. What cracks do you see emerging?
Well, I think looking at the transports, I like to use those as an early indication of where goods are moving. And, we had so much volatility post-COVID that it was hard to get a sense of it. But what you're clearly seeing is that while pricing remains strong in transports, the volumes are quite weak. And I think that's just a function of normalization of inventory levels. Last year, retailers had way too much inventory. This year, they are feeling a little more chicken and they don't have quite as much. But I think it's really important to be differentiated in retail. Coming out of COVID, we all had extra money. I could have probably made more money selling macaroni bracelets that my kid made than being a portfolio manager, quite honestly. People were buying anything that was available. And now you really have to be differentiated because inflation is really stinging consumers. So you have to show great value. I think that's why off-price is better positioned than most average retailers.
Oh, sure, as all that inventory maybe goes to those channels as well. Brian, before I kind of go back to the market piece of this, just explain why you also think this is so important, a little bit of this slowdown dynamic that we're seeing into the holiday season, what it could mean for inventories and inflation and even the Fed.
Well, as Julie mentioned, inventories are high. They've been growing at triple the pace they were pre-pandemic, and inventory turnover has slowed, and days inventory stocks is up significantly for the S&P 500. That's even worse in the semiconductor area. And when the ports were blocked on the West Coast 2 years ago, goods piled up, people double and tripled ordered. That led to inflation. But once the ports opened, we had a flood of goods coming in, and that's still persisting. It's starting to get a little bit better, but it's going to take 2 years to really work these stocks down, especially with slowing sales. So I've said on the program before that we've been in a manufacturing recession, excluding autos, since April of last year. This is going to make it harder for companies to draw down their inventories. It's going to be a negative for manufacturing, and that's a positive for bond prices, which is, in a choppy environment, overall good for stock prices.
Interesting, because you could kind of tell the story you're telling, Brian, and have it be very negative for stocks. But you think falling bond yields will ultimately be supportive?
Most of the gains in stocks this year have been from buybacks. Retail investors have kind of rolled over. Institutional investors have become more bearish. So as Julie was saying, you want to look at the companies that are growing, and I favor the companies that have enough cash flow to buy back their stock because that's where the gains have come in the past year, and I think that will be more so going forward.
Yeah, it's funny you say that as we hear, Apple's bought back $600 billion worth of its own stock in the last several years or some ridiculous amount like that. And obviously, even they sometimes can struggle. So, Julie, one of the manufacturing names you actually do like here, Simpson Manufacturing. Just talk about why in the tough manufacturing environment Brian was referring to. We obviously saw the ISM earlier this week, 12th straight month of contraction.
Well, we understand that, we're still completely underhoused in a massive way, right? But most people living at home right now have low interest rates for 30 years. They're not selling. They don't want to sell for less and end up buying a smaller house that they have to pay more for with mortgage rates. So it's just existing home sales are really just at a lock. So it's really up to new home sales to make up the difference. The problem I have is that, when you buy home builders, you're exposed to very specific geographic markets and you have higher than average idiosyncratic risk. I would rather actually own a manufacturer that has 70% market share of the home builders in a product that's actually spec'd in the building codes. And that's Simpson Manufacturing that makes their strong tie product that literally supports the structure. It's pretty critical. But it's a small cost of the build, and so I think that they're much better positioned. It's a pristine balance sheet. Those are the types of businesses that I think I'd rather own going into kind of a choppy market.